Hello everyone, and welcome. For over 2 decades, I've had the privilege of walking alongside countless individuals on their financial journeys. I've sat in boardrooms with titans of industry and had coffee with young families just starting out. And in all that time, I've come to one profound, undeniable conclusion. Doing well with money has less to do with how smart you are and everything to do with how you behave. Think about that for a moment. We're taught that money is all about formulas, spreadsheets, and complex calculations. We believe that to be successful, you need to be a Harvard-educated financial wizard. But what if I told you that the highest form of wealth has nothing to do with a spreadsheet? What if I told you that it's about having the ability to wake up every morning and say, I can do whatever I want today? That, my friends, is the highest dividend money pays. But how do we get there? How do we take control of our finances and find that freedom? I want to share 2 stories with you, both from a book that has fundamentally changed the way I think about wealth. One is about a wildly successful, wildly intelligent tech executive. This man was a certified genius, having designed and patented a key component in Wi-Fi routers. He was successful beyond measure, carrying a stack of $100 bills, several inches thick, and openly bragging about his wealth. One day, he and his friends, just for fun, threw $1,000 gold coins into the ocean, skipping them like rocks. But this is where the story takes a turn. Years later, he was broke. He had all the intelligence in the world, but he lacked a few key behavioral skills. Now contrast that with the story of Ronald James Reed, a man the book describes as an American philanthropist, investor, janitor, and gas station attendant. Ronald lived a life that was about as low-key as you can imagine. He fixed cars and swept floors for a living, lived in the same modest 2-bedroom house he bought for $12,000 at age 38, and his main hobby was chopping firewood. When he died in 2014 at the age of 92, he made international headlines. The humble janitor had a net worth of over $8 million. Those who knew him were baffled. How did he do it? There was no secret lottery win or inheritance. He simply saved what little he could, invested it in blue-chip stocks, and waited for decades on end as tiny savings compounded into a fortune. Think about this. In what other industry could someone with no college degree and no formal training massively outperform someone with the best education, the best training, and the best connections? The book argues that this is unique to finance, because financial success isn't a hard science. It's a soft skill. This is the central premise of Morgan Housel's groundbreaking book, The Psychology of Money: Timeless Lessons on Wealth, Greed, and Happiness. So many of us look at the financial world and feel lost. We're told to be rational, to follow the data, but our decisions are rarely made at a spreadsheet. They're made at the dinner table, in a company meeting, where our personal history, our ego, our pride, and our unique view of the world get scrambled together into a narrative that works for us. This book is not another guide to picking stocks or timing the market. It's a guide to understanding yourself. It will show you why no one is crazy. People from different generations, with different upbringings and different experiences, learn wildly different lessons about money. Your personal experiences with money, no matter how small, make up about 80% of how you think the world works. What seems crazy to you might make perfect sense to someone else. For example, the lowest income households in the US spend, on average, $412 a year on lottery tickets. To us, that seems insane, especially when 40% of Americans can't come up with $400 in an emergency. But to them, it might be the only plausible path to a life they can't otherwise afford. Compounding is not intuitive. It's the most powerful force in the financial universe, but its counterintuitive nature leads even the smartest among us to overlook its power. It's not about making amazing returns every year. It's about making a reasonable return and letting it grow over a very long period. Survival is the ultimate financial goal. Getting wealthy is one thing, but staying wealthy is a completely different skill. It requires a mix of humility and a constant fear of going out of business. The ability to stick around for a long time without being wiped out or forced to give up is what makes the biggest difference. This book is about recognizing that your relationship with money is driven by emotions, not just math. It's about aiming to be reasonable, not rational, because a strategy you can stick with for the long run, even if it's not perfectly rational, will always outperform a so-called perfect plan that you abandon the moment things get difficult. If you've ever felt that you are not good with money, or if you're stuck in a cycle of financial stress, this book is for you. It's not about what stocks to buy or where to invest. It's about understanding why we do what we do. It's about finding peace and control over your finances by understanding the one variable you can control yourself. I promise you, by the end of this book, you won't just know more about money, you'll know more about yourself. You'll be empowered to take control of your financial journey, not by chasing some magic formula, but by mastering the timeless lessons of human behavior. You'll learn to see wealth not as an amount in your bank account, but as the freedom to control your own time and your own life. Chapter 1. No one's crazy. The central premise of this chapter is both simple and profoundly liberating. Your personal experiences with money, no matter how small or seemingly insignificant, make up maybe 80% of how you think the world works. What seems crazy to me might make perfect sense to you because we've had different lives. Think about it. We all come from different generations, different cultures, different upbringings. If you grew up in the 1970s, you lived through the highest inflation in American history, where money lost its purchasing power year after year. Your formative financial years taught you that holding cash is a losing game. But if you grew up in the 1950s, a time of unprecedented stability and growth, you learned that the world was a predictable, safe place where hard work and saving led to prosperity. Both of these perspectives are perfectly rational responses to the world they experienced. Neither is crazy. They're just different. Housel drives this point home with a powerful and perhaps uncomfortable example. In the US, the lowest-income households spend on average over $400 a year on lottery tickets. To someone who lives in a world of compound interest and investment portfolios, this might seem like a completely irrational and self-destructive act. Why would you throw away money that you could be saving for an emergency? But Housel challenges us to look deeper. To someone living paycheck to paycheck, in a world where a $400 emergency is a crisis they can't afford, the lottery isn't a foolish bet. It's the only plausible path they can see to a life they can't otherwise afford. It's a ticket to hope. When you see it through that lens, the action is no longer irrational, it's an emotional, and to them, logical response to their reality. This is the key insight of the chapter. Financial decisions are not made on a spreadsheet. They are made at the dinner table, shaped by our unique histories, our fears and our hopes. They are a reflection of the life we have lived. So what do we do with this information? How does understanding that no one is crazy help us take control of our finances? It's the foundation of all financial wisdom. 1. Stop judging, start understanding. The first and most powerful application is humility. When you see a friend making a choice you think is foolish, whether it's spending too much on a car or not investing enough for retirement, don't jump to judgment. Instead, ask yourself, what about their life and their past might make this seem like a perfectly reasonable decision to them? Actionable step. When you're tempted to criticize a financial choice, pause. Reframe your thought from "they're so irresponsible" to "I wonder what their story is." This shift from judgment to curiosity will not only improve your relationships, but also help you avoid repeating similar mistakes. 2. Your own past is not a universal guide. This lesson is just as much about you as it is about others. You might be a natural saver because you grew up in a frugal household. You might be terrified of the stock market because you saw your family lose everything in 2008. These are not objective truths. They are personal experiences, and while they have value, you must recognize that they are not the only way to see the world. Actionable step. Take a moment to reflect on your own financial biases. When you feel a strong emotion about money, greed, fear, excitement, ask yourself where it comes from. Did you learn it from your parents, your friends, or a memorable event? By understanding the origin of your beliefs, you can decide which ones serve you and which ones hold you back. 3. The power of personal finance. This chapter makes it clear that personal finance is exactly that, personal. There is no one-size-fits-all plan. A strategy that works perfectly for a 60-year-old with a pension will be completely wrong for a 25-year-old just starting their career. This realization frees you from the pressure of following someone else's playbook. Actionable step. Instead of searching for the perfect financial guru or the right investment, focus on creating a plan that is right for you, a plan that aligns with your goals, your risk tolerance, and your unique personality. A plan you can stick with for decades, because ultimately consistency is what matters most. We've now established a crucial truth. No one is crazy. Our financial decisions are a product of our personal history. This knowledge is the first step toward taking control, but it leads us to another fascinating and sometimes uncomfortable question. If our success isn't just about spreadsheets and intelligence, then how much of it is truly in our control? And how much is simply luck? We'll tackle that next. Chapter 2. Luck and Risk. Morgan Housel's central argument is that luck and risk are two sides of the same coin. They are the unseen forces that can turn a good decision into a fantastic outcome or a reasonable decision into a catastrophic failure. Because they are invisible, we tend to underestimate their power and overemphasize the role of skill. Housel illustrates this with a compelling story about Bill Gates and a boy named Kent Evans. We all know Bill Gates's story of starting Microsoft, a narrative of immense skill and vision, but Housel points out a key detail that's often overlooked. Bill Gates, along with his future co-founder Paul Allen, went to one of the only high schools in the United States that had a computer terminal in 1968. It was pure, dumb luck. No amount of genius or hard work could have given them that opportunity if their parents hadn't chosen that specific school. This extraordinary access allowed them to get a 10-year head start on the rest of the world. Then there is the story of Kent Evans, Gates's best friend and a fellow computer prodigy at the same school. They shared the same passion, the same access to the rare computer, and the same intellectual brilliance. They planned to start a business together, just as Gates and Allen did. But a month before high school graduation, Kent tragically died in a mountaineering accident. He had all the skill in the world, but he was struck by bad luck. The lesson here is profound. If you wrote a book about Gates, it would be a story of skill. If you wrote a book about Evans, it would be a story of risk. But what we don't realize is that these two stories are inextricably linked. They both started with the same raw ingredients, intelligence, opportunity, and drive, but their outcomes were shaped by forces beyond their control. So what does this mean for our own financial lives? How do we use this knowledge to our advantage? It's not about being cynical. It's about being realistic and, most importantly, humble. Be humble when you succeed. The first practical lesson is to recognize that not all success is due to your genius. A portion of it is due to forces outside of you. Maybe you got lucky with a single stock that took off, or you started your business at the perfect moment in the economic cycle. By acknowledging the role of luck, you'll avoid the dangerous illusion that you are infallible. It prevents you from taking on excessive risk and assuming past success guarantees future results. Actionable step. When you experience a big financial win, take a moment to be grateful. Instead of thinking, "I'm a genius for picking that investment," think, "I made a good decision, and I was also lucky that the market went my way." This mindset will keep you grounded and protect you from overconfidence. 2. Be compassionate. When others fail, just as luck plays a role in success, risk plays a role in failure. You might see someone lose a lot of money and immediately think they were foolish or irresponsible. But what if they were just one of the unfortunate ones who got hit by a downturn, a layoff, or an illness they couldn't have predicted? Financial failure is not always a sign of a bad decision. Sometimes it's just a sign of bad luck. Actionable step. When you see a friend or a family member struggling financially, approach them with empathy, not judgment. You don't know the whole story. Remember that you have likely made similar decisions without suffering the same consequences, simply because you were luckier. 3. Focus on what you can control, the process, not the outcome. You can't control luck, but you can absolutely control your behavior. You can control your savings rate, your spending habits, and your long-term investing strategy. The goal is to build a financial plan that is resilient enough to withstand periods of bad luck. This means having a margin of safety, a cushion for when things inevitably go wrong. Actionable step. Instead of obsessing over market returns or trying to pick the next big winner, shift your focus to your own financial discipline. Are you consistently saving? Are you avoiding unnecessary debt? Are you investing for the long term? By mastering the process, you give yourself the best possible chance of succeeding, regardless of what the world throws at you. This chapter reminds us that true financial wisdom isn't about being the smartest person in the room. It's about recognizing the limits of our own control and building a life that is humble in its success and compassionate in the face of failure. It begs a new question for us to consider. If luck and risk are so powerful, how do we even know when we have enough? We'll tackle that fascinating question next. Chapter 3. Never Enough. The core message of this chapter is simple yet profound. The hardest financial skill is getting the goalpost to stop moving. The constant desire for more money, a bigger house, a more expensive car, is a poison that can destroy everything you've worked for, regardless of how much you have. Housel tells two powerful stories to make this point. The first is about Rajat Gupta, the former CEO of McKinsey & Company, and a director at Goldman Sachs and Procter & Gamble. He was by all accounts one of the most successful and respected men in the business world. He had a net worth of over $100 million, yet he risked it all to illegally pass along a stock tip to a billionaire hedge fund manager for a quick and relatively small profit. He had everything, but he wanted more. He ended up in prison, his reputation in tatters, a cautionary tale of a man who couldn't recognize when he had enough. The second story is about the legendary investor Charlie Munger, Warren Buffett's business partner. When he was asked about the secret to his success, he didn't talk about stocks or financial models. He said, "It's not a lot of complicated things. It's just a few simple ones, knowing what you want and staying disciplined enough to get it." He understood a core truth that escaped Rajat Gupta. The ultimate goal of wealth is not to have more, but to have enough. Housel argues that there are a few things more important than having enough. Your reputation, a good reputation, is priceless. The moment you compromise your integrity for more, you put everything at risk. Your freedom, true wealth is not a number. It's the freedom to control your own time. The pursuit of more can enslave you in a cycle of work and spending, your family and friends. No amount of money is worth sacrificing your relationships. Your happiness. The relentless chase for more is a hedonic treadmill. You reach a new level of wealth, your expectations rise, and you're back to where you started, chasing the next high. So, how do we stop the financial goalpost from moving? 1. Define enough for yourself. The first and most important step is to figure out what enough means for you. It's not a universal number, it's personal. For some, it might be the ability to retire comfortably. For others, it might be the freedom to take a sabbatical or work on a passion project. The key is to define it before you get trapped in the endless pursuit of more. Actionable step. Sit down and write out what enough looks like for your life. What number would allow you to feel secure, happy, and free? Once you have that number, you can build a plan to get there, and more importantly, you will know when to stop. 2. Recognize the illusion of more. Social comparison is a powerful force. It makes us think we need a bigger house because our neighbor has one, or a nicer car because our colleagues do. But this is an illusion. The feeling of I have enough is an internal state, not an external one. There will always be someone with more. Actionable step. Practice gratitude. Take a moment each day to appreciate what you have, rather than focusing on what you lack. This simple act can reframe your entire relationship with money and help you break free from the trap of comparison. 3. Embrace the margin of safety. One of Housel's core lessons throughout the book is the importance of a margin of safety. Having enough isn't about being perfectly optimized. It's about having a buffer. This buffer, whether it's an emergency fund or simply a conservative investment strategy, is your safety net against the risks we discussed in the last chapter. It allows you to sleep at night and to weather the inevitable storms of life without being wiped out. Actionable step. Ask yourself, how much money do I need to feel truly secure, not just wealthy? Build a plan around that number. Your goal is not to maximize returns at all costs, but to build a financial fortress that can withstand a crisis. This chapter reminds us that true wealth is not about having more than anyone else. It's about having more than you need, so that you can live a life of freedom, dignity, and peace. It leads us to a crucial question that will shape everything else. If the goal is not to become a billionaire, what is the secret to building lasting wealth? The answer might surprise you, and it has to do with the most powerful force in the financial universe, compounding. We'll delve into that next. Chapter 4. Confounding compounding. The central idea of this chapter is that compounding is not intuitive. Our brains are wired for linear short-term thinking. We see a tree grow a few inches in a year and think, okay, that's what a tree does. We don't instinctively grasp that after 50 years, that same tree will be a towering giant. Compounding works the same way. The magic happens so slowly in the beginning that it's easy to dismiss, but its power is almost unimaginable over time. Housel uses the story of Warren Buffett to illustrate this. We all know him as one of the richest men in the world. The narrative is that he's a brilliant investor, and he is. But Housel points out that the vast majority of Buffett's wealth was accumulated after his 50th birthday, and more than 99% of it was accumulated after he turned 60. This isn't just because he's a genius. It's because he has been a good investor for a very long time. His real secret isn't that he made the best returns, it's that he started young and has stuck with it relentlessly for over 7 decades. The returns he made in his 20s, 30s, and 40s were just the foundation. The real money was made when those returns had decades and decades to compound on top of each other. The lesson here is profound. A good return, maintained consistently for a long time, will always outperform a phenomenal return that you can't sustain. So how do we harness this confounding power in our own lives? 1. The single most important thing is time. You don't need to be the next Warren Buffett or pick the next hot stock. Your greatest financial asset is your age. The more time you have, the more powerful compounding will be. Starting to save and invest in your 20s is far more valuable than trying to make up for lost time in your 40s. Actionable step. If you're young, the best thing you can do for your financial future is to start saving and investing today. Even a small amount, like $50 a month, consistently invested over decades, will create a powerful financial snowball. If you're older, don't despair. The principle still applies. Start today and be disciplined. 2. The goal is not to get rich quick, but to get rich slowly. Our society is obsessed with get-rich-quick schemes. We're bombarded with stories of overnight successes, but these are exceptions, not the rule. The truly wealthy, the people who build lasting fortunes, do it through slow, boring, consistent compounding. Actionable step. Stop chasing the flashy headlines and the high-risk gambles. Instead, focus on a simple, consistent plan. This could be something like investing in a low-cost index fund every month, maxing out your retirement accounts, and letting time do the heavy lifting. Boring is a superpower in finance. 3. Surviving is more important than winning. Housel brings back the idea of a margin of safety from the last chapter, but now in the context of compounding. In order for compounding to work its magic, you must survive. You can't be wiped out by a single bad decision, a market crash, or a personal emergency. The greatest risk to compounding is being forced to stop compounding. Actionable step. Build a financial plan that is so sturdy, it can withstand the unexpected. This means having an emergency fund, avoiding excessive debt, and having a diverse portfolio that won't get wiped out by a single stock or a single industry. Your number one goal is to stay in the game so that compounding can do its work. This chapter teaches us that finance isn't just a race to the finish line. It's a test of endurance. It's a marathon, not a sprint. We've now laid the foundation. We're humble. We've defined enough, and we understand the magic of time. But this all leads to a new challenge. Getting wealthy is one thing, but staying wealthy is a completely different skill. And as we'll see, it often requires the opposite mindset. We'll explore that next. Chapter 5. Getting wealthy versus staying wealthy. The core idea of this chapter is that these two skills require almost opposite mindsets. Getting wealthy often requires risk-taking, optimism, and an openness to new ideas. It's about taking action and being a go-getter. Staying wealthy, however, requires the complete opposite. It demands humility, a certain degree of paranoia, and an understanding that what you have can be taken away in an instant. It's about being conservative and defensive. Housley uses a powerful analogy. A boxer, getting into the ring and winning, requires an offensive mindset. You have to be aggressive, take chances, and knock out your opponent. But staying a champion requires a different approach. A champion knows the importance of defense. They know when to duck, when to block, and how to survive the inevitable blows. They understand that the only way to hold on to the title is to avoid getting knocked out. In the world of money, getting wealthy is about taking some big swings. It's about investing in a new company, starting a business, or taking a high-risk job. Staying wealthy, however, is about recognizing that a lot of your success was due to luck and that you must protect what you've earned. Housley's most poignant example is the story of how many wealthy people lost their fortunes in the 1930s during the Great Depression. They were masters at getting wealthy, but were completely unprepared for the sudden catastrophic risk that came with a market collapse. They lacked a staying wealthy mindset. So how do we master both skills and build a financial life that is not only prosperous, but also resilient? One, always have a margin of safety. This is the most critical lesson in this chapter. It's not enough to just save money. You need to save money with a purpose. That purpose is to create a cushion, a margin of safety that protects you from the unexpected. This could be an emergency fund that can cover 6 months of expenses, a conservative investment allocation, or simply living below your means, so you have a buffer for when things go wrong. Actionable step: review your budget and your savings. Are you living on the edge, or do you have a significant safety net? Your goal should not be to earn the highest return, but to ensure you can survive a downturn or a personal crisis without being forced to sell your investments or go into debt. 2. Recognize that extraordinary returns are not sustainable. When we see a hot investment that's going up 50% a year, our first instinct is often to go all in. But as Housley points out, this is a dangerous mindset. Extraordinary returns are often a sign of extraordinary risk. The mindset of staying wealthy understands that these kinds of returns are not repeatable and are often a sign of a bubble or a risky venture. The goal is to get rich slowly, not to become a billionaire overnight. Actionable step: if an investment sounds too good to be true, it probably is. Instead of chasing the next big thing, focus on boring, consistent long-term returns. This is what allows compounding to work its magic. A 7% annual return for 40 years is far more valuable than a one-time 100% gain that you lose in the next year. 3. The end game is survival. The ultimate goal of all financial planning isn't to be the richest person in the cemetery. It's to have the freedom to live the life you want for as long as you want, and that means not being forced out of the game. The ability to survive is what allows you to continue to compound your wealth and live your life on your own terms. Actionable step: build your financial plan with the primary goal of not being wiped out. Ask yourself, what would happen if the market dropped by 50% tomorrow? What if I lost my job? What if an unexpected medical expense came up? By preparing for these scenarios, you're not being pessimistic. You're being a realist. You are building a plan that will last. This chapter is a sobering and vital reminder that the skills of a starter are not the same as the skills of a finisher. By embracing humility, conservatism, and a margin of safety, you can ensure that the wealth you build not only grows, but also endures. This leads us to a new exciting question. What does it mean to be a successful investor in a world where most of the returns come from a very small number of events? We'll tackle that next. Chapter 6. Tails You Win. The central idea of this chapter is that most of the returns in investing are generated by a very small number of events, or tails. Our brains are wired to think of outcomes as a normal bell curve distribution. But in the world of investing, outcomes are anything but normal. A few companies, a few decisions, or a few brilliant ideas will generate the vast majority of the wealth, while many others will fail or simply go nowhere. Housel uses an incredibly powerful example to make this point. Think about the S&P 500, which is an index of the 500 largest public companies in the US. Over the past few decades, its returns have been spectacular. But the data shows that just 4% of the companies in the Russell 3000, a broader index of 3,000 US companies, have been responsible for all of the market's net gains since 1980. The other 96% of companies, on average, performed no better than a treasury bill. This is a staggering truth. If you had invested in a portfolio of 2,999 companies and just missed that 1% of superstars, your returns would have been mediocre at best. This isn't a fluke. It's a fundamental reality of capitalism. A few home runs, like Amazon, Apple, or Microsoft, will always generate a disproportionate amount of the wealth. This is the beauty of tails. You don't have to be right on everything. You just have to be right on a few things that go on to be massive winners. So what does this mean for our own financial lives? How do we apply this knowledge to our own investing? 1. Don't get discouraged by bad investments. This is a liberating lesson. If you've ever had an investment that went to zero or a business idea that failed, don't beat yourself up. You are not a bad investor. You are simply participating in a system where most things fail. What matters is that you're in the game, and that you are taking enough shots to have a chance at hitting a winner. Actionable step. When an investment goes bad, see it as a normal part of the process, not as a personal failure. Be willing to accept that most of your investments will be mediocre, and that's okay. Your goal is to be patient enough to hold on to the few that become life-changing. 2. Diversification is your best friend. If a small number of companies generate the majority of returns, how do you make sure you own them? The answer is simple. Diversification. You don't know in advance which companies will be the winners. You don't know which startup will become the next Amazon. Therefore, the most logical strategy is to own a broad basket of companies so that you're guaranteed to own the few that succeed. Actionable step. Instead of trying to pick individual stocks, invest in a low-cost, broadly diversified index fund. This strategy ensures that you own a piece of every company in the index, including the future superstars. It's a simple, elegant way to capture the power of the tails. 3. Be patient and let the winners run. The biggest mistake investors make is selling their winners too early. Because the majority of returns come from a few companies, if you sell your home runs too early, you're cutting off your biggest source of wealth. The hardest part of investing isn't finding a great company. It's having the patience and discipline to hold it for decades as it compounds into a fortune. Actionable step. When an investment doubles or triples, fight the urge to sell it all and lock in your profits. Instead, think about the long-term potential. Remember that the vast majority of Warren Buffett's wealth came from holding on to his winning investments for decades. This chapter reminds us that a successful investment journey isn't about being right all the time. It's about being patient enough for the rare few times you are right to change your life. It leads us to a new and important question. If wealth isn't about money in the bank, then what is it really about? And how does that understanding change our goals? We'll tackle that next. Chapter 7. Freedom. The core idea of this chapter is that the highest dividend money pays is the ability to control your own time. It's not the fancy car, the big house, or the expensive watch. Those things are often just signals to others that you have money. The truest form of wealth is the freedom to wake up in the morning and say, I can do whatever I want today. Housel drives this point home by showing that throughout history, and even today, The primary reason people want money is to control their own lives. A higher salary isn't just about a bigger number. It's about the ability to work fewer hours, to quit a job you hate, or to take a break without a boss's permission. He cites a study showing a strong correlation between time spent commuting and lower happiness. The study found that a 20-minute increase in commute time had the same negative impact on job satisfaction as a 19% pay cut. This isn't about the money itself. It's about the loss of control over your time. This redefines our entire understanding of what we should be working toward. The goal isn't just to accumulate more. It's to create a life where you have more autonomy. So how do we use this insight to change our financial lives for the better? 1. Stop chasing status and start chasing time. So much of our spending is driven by a desire for social status. We buy things to impress others, often without realizing that what we really want is their respect and admiration. But Housel points out a paradox. The person in the fancy car might be admired for a moment, but the person who owns a home outright, or who can take a year off to travel, is living a life of true wealth. They have time, not just things. Actionable step. Before you make a large purchase, ask yourself, is this purchase for me, or is it to impress someone else? Focus your spending on things that buy you more time, more experiences, and more freedom, rather than on things that just signal status. 2. Prioritize a high savings rate over high income. We've been taught that a higher income is the key to financial freedom, and while income is important, it's not the whole story. As we learned in Chapter 3, the goalpost of enough can keep moving. A high income can lead to lifestyle creep, where you spend more as you earn more, leaving you no better off than before. The real path to freedom is a high savings rate. A person who earns a modest salary but saves a large portion of it will gain control over their time much faster than a high earner who spends all of it. Actionable step. Focus on increasing the gap between what you earn and what you spend. Instead of constantly trying to increase your income, try to reduce your expenses and increase your savings rate. This is one of the fastest ways to gain financial independence. 3. The end game is independence. Ultimately, money isn't just for buying things, it's for buying yourself a sense of security and independence. The greatest financial safety net isn't a high-paying job, it's the ability to walk away from a job you hate, or to not have to take one in the first place. That level of independence gives you the power to make decisions based on what is best for you, not what is best for your boss or your lender. Actionable step. Make independence your ultimate financial goal. View every dollar you save, not as a simple number in a bank account, but as a small piece of your future freedom. It's a powerful shift in perspective that will motivate you to save more and spend less. This chapter reminds us that true wealth is an internal state of being, not an external display of things. It's about having the power to say no to things you don't want to do, and yes to things you love. It leads us to a new and interesting paradox. How do we reconcile the desire for wealth with the reality that most people's definition of wealth is something that they themselves will never achieve? We'll explore that next. Chapter 8. Man in the Car Paradox. The core idea of this chapter is simple yet profound. No one is as impressed with your possessions as you are. When you buy a fancy car, you think people will look at you and think, wow, that person is successful. But in reality, they're looking at the car and thinking, wow, if I had that car, people would think I'm successful. Housel uses the analogy of the man in the car. The person in the expensive car wants to be admired, but the person looking at them isn't admiring them. They're admiring the car and imagining themselves in it. The respect you seek is not for you, but for your stuff. This is a fundamental paradox of status-driven spending. The things we buy to gain respect are often the very things that make others want to emulate the object, not the person who owns it. This is a dangerous trap because it leads to an endless cycle of spending. If you believe that your possessions will bring you respect, you'll never have enough. As soon as you buy one thing, you'll see something new and shiny, and the feeling of admiration you crave will be just out of reach. So, How do we break free from this paradox and achieve the respect and admiration we truly desire? 1. Understand the difference between respect and envy. The person who sees your luxury car might feel envy, but envy is a fleeting emotion. It's not the same as respect. Respect is earned over time through your actions, your character, your generosity, and your kindness. You can't buy respect. You can only earn it. Actionable step. When you feel the urge to buy something expensive to keep up with the Joneses, ask yourself what you truly want. Is it the item, or is it the feeling of being admired? If it's the latter, focus on building your character and relationships instead of your collection of possessions. 2. Wealth is what you don't see. Housel introduces the idea that wealth is what you don't see. We can see the mansion and the expensive car, but we can't see the money in the bank, the investments or the retirement accounts. The truly wealthy are often the ones who don't feel the need to show off. Their wealth is a quiet, private confidence that allows them to live a life of freedom without seeking external validation. Actionable step. Shift your focus from visible wealth to invisible wealth. Celebrate your high savings rate, the growth of your investments, and the security of your emergency fund. These are the true markers of financial success, even if no one else can see them. 3. The greatest respect comes from a life well lived. Ultimately, the best way to earn respect isn't by having the most stuff. It's by living a life of financial freedom that allows you to be generous with your time, your money, and your spirit. People respect those who are independent, who have the ability to help others, and who are not trapped in a cycle of work and spending. Actionable step. Think about the people you truly admire. Is it because of what they own, or is it because of who they are? The answer is almost always the latter. Use this as a guide for your own financial journey. Build a life that you're proud of, not just one that others are envious of. This chapter is a powerful reminder that our financial journey isn't just about numbers, it's about our relationship with ourselves and with others. By releasing the need for external validation, we can focus on building true, lasting wealth that provides not just security, but also a life of purpose and freedom. This leads us to a new, exciting question. If wealth is invisible, how do we build it? We'll tackle that next. Chapter 9. Wealth is what you don't see. The core idea of this chapter is simple yet powerful. Wealth is not what you can see, it's what you can't. We often conflate being wealthy with being rich. Being rich is about showing off what you have. Being wealthy, however, is about the money you've saved and the assets you've built that are not visible to the outside world. Housel argues that people who drive expensive cars and live in big houses are by definition demonstrating that they are rich, but they are not necessarily wealthy. Why? Because the money they spent on that car or house is money they no longer have. Their desire to signal their success to others has actually made them less wealthy. Their wealth is a negative number, as Housel puts it. If you want to be rich, you have to spend money. If you want to be wealthy, you have to not spend money. The most powerful example of this is a person who lives in a modest home, drives a reliable but inexpensive car, and saves a significant portion of their income. They may not look wealthy to the outside world, but they are. Their wealth is in their bank accounts, their investment portfolios, and their future freedom. It's the money that is not being spent on visible status symbols. So how do we shift our mindset from chasing visible riches to building invisible wealth? 1. Stop trying to impress others. This is a direct follow-up to the man in the car paradox from the last chapter. The things we buy to impress others are often the very things that make us less wealthy. The desire for social status is a never-ending treadmill. The moment you buy one thing, there will be a new, shinier thing to chase. The key is to realize that the person you're trying to impress isn't impressed with you anyway. They're only thinking about what they would do if they had what you have. Actionable step. Before you make a purchase, ask yourself who it's for. Is it for your own joy, or is it to get a reaction from someone else? Focus on building a life that brings you genuine satisfaction, not one that is built on the fleeting validation of others. 2. Embrace frugality as a superpower. In a world obsessed with luxury and status, being frugal is a quiet act of rebellion. It's not about being cheap. It's about being intentional. It's about recognizing that every dollar you save is a dollar you are using to build a more secure and free future. It is a powerful tool for building wealth. Actionable step. Find ways to save money that don't feel like a sacrifice. This could be by packing your lunch, using a more affordable streaming service, or simply questioning your spending habits. Every small act of frugality is a step toward building your invisible fortress of wealth. 3. The goal is not to have a high net worth, but to have a high savings rate. We often obsess over our net worth, but as Housel argues, our savings rate is a much more important metric. A high savings rate is a direct measure of your ability to control your own behavior and to live below your means. It's the engine of wealth regardless of your income. A person who earns $50,000 and saves $10,000 a year will be wealthier in the long run than a person who earns $200,000 and saves nothing. Actionable step. Shift your focus from how much can I earn to how much can I save. This change in perspective will empower you to take control of your financial life, regardless of your income level. This chapter reminds us that true wealth is a quiet, powerful force that is built through discipline and patience. It's an internal measure of your security and freedom, not an external display of your possessions. This leads us to a new question. If saving money is so important, why is it so hard to do? We'll tackle that next. Chapter 10. Save money. The core idea of this chapter is that your savings rate is a more powerful lever for building wealth than your income or investment returns. This might sound counterintuitive. We're taught to focus on earning more money, but Housel argues that how much you save is the one thing you can completely control. Your salary is dictated by your employer, and your investment returns are dictated by the market. But your savings rate is a direct reflection of your ability to live below your means. Housel explains that building wealth is not about earning a huge salary. It's about a high savings rate. A person who earns a moderate income but saves a large portion of it will inevitably become wealthier than a high earner who spends everything they make. Why? Because the person who saves more has more control. They have a larger buffer against unexpected expenses, a shorter time to financial independence, and the ability to take on less risk. He makes a simple but profound point. The ability to save is not tied to your income, it's tied to your ego. When we spend money on things we don't need, it's often to keep up with others or to signal our status. The antidote to this is humility. When you're humble, you don't feel the need to show off, and you can focus on building a silent, invisible fortune. So how do we make saving money a core part of our financial lives? 1. Stop thinking about saving as a sacrifice. We often view saving as giving up something today for something in the future, but Housel challenges this mindset. He argues that saving isn't a sacrifice. It's a way to buy future happiness and freedom. Every dollar you save is a vote for a future where you have more options, more security, and more control over your time. Actionable step. Change your internal narrative about saving. Instead of thinking, I can't buy this, think I am choosing to buy a more secure and free future. This shift in perspective can make saving feel empowering rather than restrictive. 2. Live below your means, regardless of your income. The most powerful financial habit you can develop is to live below your means. This is the single most effective way to ensure that your savings rate remains high. It's not about how much you earn, it's about how much you keep. The key is to avoid lifestyle creep, which is the tendency to spend more as you earn more. Actionable step. Create a budget and track your spending. Be honest with yourself about where your money is going. Find small ways to cut back and redirect those funds into your savings or investment accounts. Remember, every little bit counts. 3. The greatest return is your peace of mind. While we often focus on the investment returns our savings generate, the greatest return on your money is the peace of mind that comes from having a financial cushion. This cushion allows you to sleep at night, to weather a job loss or an emergency, and to avoid making rash financial decisions out of desperation. Actionable step. Prioritize building an emergency fund that can cover at least 3 to 6 months of living expenses. This is the foundation of your financial life. It's a non-negotiable step that will provide you with a sense of security that no market return can match. This chapter reminds us that true financial power is not found in high-flying returns or a massive income, but in the quiet, consistent discipline of living below your means and saving for your future. It sets us up for a new and profound question. In a world driven by logic and data, why is it that being reasonable is often more effective than being rational? We'll tackle that next. Chapter 11. Reasonable is more than rational. The core idea of this chapter is that a plan you can stick with is better than a perfect plan that you can't. A rational financial decision is one that is based purely on data, logic, and mathematics. It assumes a person will always make the most optimal choice. A reasonable decision, on the other hand, acknowledges that people have emotions, biases, and unique life experiences. A reasonable plan is one that is emotionally sustainable, even if it's not the most mathematically optimal. Housel uses the analogy of investing. A rational investor would use a complicated formula to determine the absolute best time to buy or sell, or to find the single stock that will produce the highest return. They would likely engage in market timing and frequent trading. A reasonable investor, however, understands that this is a recipe for disaster. It is impossible to time the market, and the stress of trying will lead to poor decisions. Instead, a reasonable investor creates a simple, boring plan, like investing in a diversified index fund every month and holding on for decades. This plan may not be rational in the sense that it doesn't try to beat the market, but it is eminently reasonable because it can be followed for a lifetime without a single moment of emotional stress. The most powerful example Housel gives is the difference between a high-yield savings account and a simple checking account. Rationally, you should put every penny of your emergency fund in the highest yield account you can find. But is that reasonable? What if that high-yield account is with a small, lesser-known bank? The reasonable person might choose to keep their emergency fund in a slightly lower-yielding account at a large, well-known bank, because the peace of mind is worth more than the extra few dollars of interest. The peace of mind is the dividend that a rational model can't account for. So how do we shift our mindset from trying to be perfectly rational to simply being reasonably effective? 1. Embrace the good enough strategy. Our obsession with perfection can be our financial undoing. We spend hours trying to find the absolute best mutual fund, the perfect time to buy a house, or the most optimal retirement plan. But this search for perfection often leads to paralysis. The most important thing is to simply get started and stick with it. A plan that is good enough is far superior to a perfect plan that never gets implemented. Actionable step. Stop searching for the perfect investment or the perfect moment to start saving. Start with a simple diversified fund. Start saving a small amount today. The power of compounding, which we learned about in Chapter 4, will do the rest of the work for you over time. 2. Your emotions are not a bug, they're a feature. Rational models assume you are a spreadsheet-making robot. They completely ignore the human element of fear, greed, and anxiety. A reasonable financial plan, on the other hand, builds in a buffer for these emotions. It acknowledges that there will be market crashes and that you will feel scared. By having a margin of safety, which we learned about in Chapter 5, you can ride out these periods of stress without being forced to make a bad decision. Actionable step. Acknowledge your emotional state. If you know you are prone to panicking during a market downturn, then a more conservative investment strategy might be right for you, even if it's not rationally the highest returning one. Your peace of mind is a valuable asset. 3. Simplicity is a sign of strength. The most complicated financial models often break down under stress. The most resilient financial plans are often the simplest ones. They are based on a few core principles: save money, live below your means, and invest for the long term. This simplicity makes it easy to follow, even when the world feels chaotic. Actionable step. Simplify your financial life. Consolidate your accounts, automate your savings, and create a simple, easy-to-follow plan. The less you have to think about your finances on a daily basis, the more likely you are to stick with your plan over the long run. This chapter reminds us that finance isn't a science, it's a behavior. By being reasonable, not rational, we can create a financial plan that not only works on paper, but also works in the real world of human emotions and imperfections. This leads us to a new and important question: what happens when the world surprises us? We'll tackle that next. Chapter 12. Surprise. The core idea of this chapter is that the most important events in finance, the ones that have the biggest impact, are a surprise. Our brains are wired to study history and look for patterns. We analyze past market crashes, past economic booms, and past trends, and we assume the future will look something like the past. But as Hausler points out, the most consequential financial events are always the ones that have no historical precedent. They are what Nassim Nicholas Taleb calls black swans. Think about the Great Depression, World War II, or the 2008 financial crisis. No one saw these coming. Or consider the explosive growth of companies like Apple and Amazon. No one could have predicted their dominance. The most significant financial events of the last century were a complete surprise. Hausler argues that this creates a dangerous trap for investors. We spend so much time studying the past that we become overconfident in our ability to predict the future, when in reality, the future will be shaped by things we can't possibly foresee. The most valuable lessons of financial history are not in the specific events, but in the universal truth that unexpected things will happen. So how do we invest in a world where the future is fundamentally unpredictable? 1. Be humble about your predictions. The first step is to accept that you can't predict the future. Acknowledge that a significant portion of your financial success or failure will be determined by events you never saw coming. This is not a reason to be a pessimist, it's a reason to be prepared. Actionable step. When you read a market prediction or a forecast for the economy, take it with a grain of salt. Instead of building a plan based on a specific outcome, build a plan that can survive any outcome. 2. Prepare for the unthinkable. If the future is full of surprises, then the only rational response is to build a financial plan that has a large margin of safety. We've talked about this before, but in this chapter, it takes on a new importance. A margin of safety isn't just for a minor hiccup. It's for the unthinkable. Actionable step. Ask yourself, what if the market drops by 50% tomorrow and my company lays me off? What would I do? By building a plan that can survive this kind of scenario, with a large emergency fund and a diversified portfolio, you are preparing for the inevitable surprises of life. 3. The greatest return is the ability to stay in the game. In a world of surprises, the most valuable financial asset you can have is the ability to stick around. As we learned in our discussion on compounding, the real magic happens over decades, not years. But if a surprise event forces you to sell your investments or give up on your financial plan, you lose all the power of compounding. The most important thing is to avoid being knocked out. Actionable step. Prioritize your financial survival above all else. Avoid taking on too much debt, and don't make investments that could wipe you out. Your goal is to be resilient enough to weather any storm, so you can benefit from the long-term upward trajectory of the market. This chapter is a sobering and vital reminder that financial success is not about being smart. It's about being prepared for a world that will always surprise you. This leads us to a new and perhaps most important question. What is the most important part of our financial plan? The answer might surprise you, and it has to do with something we've already discussed: room for error. We'll tackle that next. Chapter 13. Room for error. The core idea of this chapter is that a margin of safety is the single most important component of a successful financial plan. We live in a world that is fundamentally unpredictable. Surprises will happen. As we learned in Chapter 12, surprise, the most impactful events are often the ones we can't possibly foresee. A margin of safety is your defense against a world full of surprises. It is a buffer, a cushion, and a non-negotiable part of your financial life. Hausler uses an excellent analogy to explain this. An engineer building a bridge will build it to withstand a 300,000-pound truck, even if the heaviest truck they expect to cross is only £100,000. Why? Because they know the world is messy. Materials might not be perfect. Conditions might be unusual. And someone might try to cross with a truck that is heavier than expected. The extra £200,000 is the margin of safety. It's not there to be used. It's there to protect against the unexpected. In finance, a margin of safety is your emergency fund, your conservative investment strategy, and your willingness to live below your means. It is the antithesis of optimism. It is the recognition that no matter how good you are at predicting the future, you will be wrong. So how do we build this crucial margin of safety into our financial lives? 1. Embrace pessimism. We are often told to be optimists. We are told to believe in the future, and while optimism is a good long-term strategy, Housel argues that when it comes to your financial plan, a certain degree of pessimism is essential. This isn't about being negative. It's about being prepared. It's about asking, what if things don't go according to plan? Actionable step. When you're making a financial decision, consider the worst-case scenario. If you're thinking about buying a house, ask yourself what would happen if you lost your job. If you're thinking about investing in a risky stock, ask yourself what would happen if it went to zero. By preparing for the worst, you are making yourself more resilient. 2. Your goal is to stay in the game. The greatest power of a margin of safety is that it allows you to stay in the game. It allows you to weather a market downturn without being forced to sell your investments at a loss. It allows you to survive a job loss without going into debt. As we've seen throughout the book, the real magic of wealth building comes from compounding over time. But if you are forced to stop compounding, you lose everything. Actionable step. Your number one financial priority should be to build a fortress that can withstand any storm. Avoid high-interest debt and build a significant emergency fund. These are not exciting things to do, but they are the most important things you can do. 3. The greatest return is a good night's sleep. We often measure our financial success by the returns on our investments, but Housel argues that the greatest return you can get is not a higher percentage, but a good night's sleep. The peace of mind that comes from knowing you are prepared for the unexpected is more valuable than any amount of money. Actionable step. When you're making a financial decision, ask yourself if it will help you sleep better at night. If it's a risky investment that will cause you stress, it's not worth it. The goal is to build a financial life that provides you with a sense of calm and security, not one that is a source of constant anxiety. This chapter reminds us that a successful financial plan is not just about making money, it's about ensuring your survival in an unpredictable world. By building in a margin of safety, you are not being a pessimist, you are being a realist. This leads us to a new and important question. What happens when our financial goals change over time? We'll tackle that next. Chapter 14. You'll change. The core idea of this chapter is that your financial goals, desires, and personality will change over time. We tend to think of our future selves as a stable version of who we are today, but this is a dangerous illusion. The person you are at 25 has fundamentally different priorities and beliefs than the person you will be at 45 or 65. The things you value today, a high-paying job, a fancy car, may be completely unimportant to you in a few decades. Housel calls this the end of history illusion. We know that our personalities and goals have changed in the past, but we mistakenly believe that we have reached our final form. This is why a 20-year-old might choose a career with a huge salary, but a miserable work-life balance, only to discover in their 40s that they would trade all that money for more time with their family. This illusion can lead to a phenomenon called sunk costs, where we continue to pursue a goal we no longer care about, simply because we have already invested so much time and money into it. A person might stay in a job they hate for 20 years, not because they still want the money, but because they can't bear the thought of starting over. So how do we plan for a future with a person we don't know yet? 1. Embrace the idea that you'll be a different person. The first step is to accept that you are a work in progress. Your personality, your goals, and your values will all evolve. This isn't a bad thing. It's a natural part of life. By accepting this, you can build a financial plan that has enough flexibility to adapt to your future self. Actionable step. When you're making a long-term financial decision, ask yourself, will I still want this in 20 years? If you're not sure, build in an escape hatch. For example, if you're buying a house, buy one that can be easily rented out or sold if your life plans change. Avoid extreme goals and decisions. Because you can't predict your future self, it's dangerous to lock yourself into a financial plan that has no room for change. An extreme plan like retiring at 30 or living in a remote cabin with no connection to the outside world might sound appealing today, but it could be a prison for your future self. The key is to build a life with options. Actionable step. Avoid making financial decisions that are so rigid that you can't change your mind. Instead of aiming for a single fixed retirement number, focus on building a sustainable lifestyle that can be adjusted as your needs and desires evolve. 3. The greatest investment is in your personal growth. The most powerful thing you can do for your future is to invest in yourself. This isn't about getting a better job. It's about learning and growing as a person. The more you learn about yourself and the world, the better equipped you will be to handle the inevitable changes that come with life. Actionable step. Spend time on personal development. Read books, listen to podcasts, and try new things. The more you know about yourself, the less likely you are to make a financial decision that your future self will regret. This chapter reminds us that a successful financial plan is not about predicting the future. It's about preparing for a future that is fundamentally unpredictable. It's about building a life that is so flexible and resilient that it can accommodate a person who you don't even know yet, your future self. This leads us to a new and important question. What is the most valuable thing you can do in your financial life? We'll tackle that next. Chapter 15. Nothing's free. The core idea of this chapter is that everything has a price, and the price of a great investment return is not paid in dollars, but in volatility, fear, uncertainty, and doubt. We often think of great investments as a free lunch. We see a stock that has gone up 1,000%, and we think, why didn't I buy that? But what we don't see is the price that was paid by the investor who held on to that stock, the days, weeks, months, or even years when the stock was down, when the news was bad, and when everyone was telling them to sell. Housel argues that every great investment has a volatility tax. When you buy a great company, you are not just buying the stock, you are buying the right to endure all the emotional pain that comes with holding it. The person who holds a stock through a 50% drop is not a lucky genius. They are a person who has paid the price of a great return. He uses the example of Amazon. Today we see Amazon as a tech giant that was an obvious bet from the start. But a rational investor in the year 2000 would have seen a company that had lost 90% of its value. They would have seen a company that lost money year after year. The price of investing in Amazon was not the stock price. It was the emotional toll of holding on for a decade and a half, while everyone was telling you it was a worthless company. So how do we use this insight to change our financial lives for the better? 1. Stop complaining and start paying. The first step is to accept that there is no free lunch in investing. When the market goes down, it's not a bug, it's a feature. It's the price you have to pay to get the long-term returns. By reframing volatility as a fee, you can stop complaining about it and start paying it with a sense of purpose. Actionable step. When the market gets volatile, don't panic. Instead, remind yourself that this is the price of admission. This is the fee you're paying for long-term compounding. By accepting this reality, you are less likely to make a rash, emotional decision that will cost you in the long run. 2. Your perfect plan has a price. We often look for the perfect investment or the perfect strategy, but as Housel points out, even a perfect strategy has a price. The price might not be in the form of a fee, but in the form of emotional pain. For example, a perfectly diversified portfolio will not have a perfect year. Some of the assets will go down, The price of that diversification is the emotional pain of seeing a portion of your portfolio go down. Actionable step: stop looking for a perfect plan and start looking for a reasonable plan that you can stick with. A reasonable plan is one that acknowledges that you will have to pay a price in the form of volatility, but that the long-term payoff is worth it. 3. The greatest returns come from a long-term mindset. If the price of a great investment is a long-term commitment, then the greatest returns will go to those who are patient enough to pay that price. It's not about being a genius. It's about being a master of your own emotions. Actionable step: reframe your financial goals. Instead of trying to get a quick return, focus on building a long-term plan that you can stick with for decades. The patience and discipline to ride out the inevitable storms are the real superpowers of finance. This chapter is a vital reminder that financial success is not about avoiding risk. It's about paying the price of risk with your emotional resilience. It's about recognizing that there is no free lunch in investing, and that the greatest returns come to those who are willing to endure the emotional cost. Chapter 16. You and Me. The core idea of this chapter is that no amount of advice, data, or books will ever replace the unique financial lessons that you learn from your own life. We often look at the financial decisions of others and judge them, or we try to emulate the strategies of famous investors like Warren Buffett. But as Housel points out, your financial life is not a math problem, it's a personal story. The lessons you learn from your own mistakes and successes are far more powerful than anything you will ever read. He uses the example of a person who has lived through a severe recession. That person will have a fundamentally different view of risk than someone who has only ever known a bull market. The person who lived through a recession will likely be more conservative, even if all the data tells them that they should be taking more risk. This is not a sign of irrationality, it's a sign of a deep personal truth that has been seared into their memory. Housel argues that there is no single right way to handle money. There is only the way that works for you. Your unique experiences, your risk tolerance, your goals, and your personality all combine to create a financial fingerprint that is unique to you. So how do we use this insight to take control of our financial lives? 1. Stop comparing yourself to others. The most dangerous thing you can do on your financial journey is to compare your progress to that of others. Your neighbor's new car, your friend's high-flying stock portfolio, or your colleague's rapid promotion are all things that are unique to them. They have different histories, different goals, and a different relationship with risk. Your job is not to be them, it's to be the best version of you. Actionable step: unfollow financial gurus and stop paying attention to what others are doing. Focus on your own goals and your own progress. The only person you should be competing with is the person you were yesterday. 2. Your financial plan should be a reflection of you. A financial plan that works on paper but doesn't work for you is a bad plan. You should not be a slave to your financial plan. Your financial plan should serve you. This means that if a particular investment strategy or a certain budget makes you feel anxious or stressed, it's not the right plan for you, regardless of how rational it might be. Actionable step: build a financial plan that aligns with your personality. If you're a person who is prone to worrying, then a more conservative investment strategy and a larger emergency fund might be the right choice for you. Your peace of mind is worth more than a few extra percentage points of return. 3. The greatest financial lesson is a personal one. Ultimately, the most important financial lessons are not learned from a book or a podcast. They are learned from your own life. The first time you save a significant amount of money, the first time you invest in the market and see it go up, or the first time you weather a financial storm, these are the experiences that will fundamentally change your relationship with money. Actionable step: reflect on your own financial journey. What lessons have you learned? What mistakes have you made? And what have you done right? By understanding your own story, you can build a financial plan that is not just based on data, but on a deep personal wisdom. This chapter is a powerful reminder that there is no one-size-fits-all solution to personal finance. The key to a successful financial life is not to follow someone else's playbook, but to understand yourself, your emotions, and your own unique history. It's a liberating idea that puts you in the driver's seat of your own financial destiny. Chapter 17. The Seduction of Pessimism. The core idea of this chapter is that pessimism sounds smarter and more plausible than optimism. Optimism, by its very nature, sounds naive. When someone says, "The world will get better," it's easy to dismiss them as an idealist. But when someone says, "The market is going to crash," it sounds like a hard, pragmatic truth. This is because progress is a slow, quiet, and often boring process, while catastrophe is loud, dramatic, and instantaneous. Housel uses the example of the stock market. Over the long term, the market has always gone up, but the story of the market is not told in a chart that goes from the bottom left to the top right. It's told in the headlines of a few dramatic crashes: the 1929 crash, Black Monday in 1987, the dot-com bubble, and the 2008 financial crisis. These are the stories that dominate our attention and shape our view of the world. As a result, we are constantly on the lookout for the next big crash, even though the long-term trend is overwhelmingly positive. Housel argues that this is a dangerous bias. Optimism is not just about believing that things will get better. It's about having the conviction that even when things go wrong, they will eventually go right again. Pessimism, on the other hand, is a seductive lie. It gives you the illusion of being smart and in control, but it ultimately keeps you from participating in the greatest wealth-building machine in human history. So how do we overcome our natural bias toward pessimism and embrace a more productive optimism? 1. Recognize that progress is a quiet process. The first step is to recognize that progress is not a single event. It is a slow, day-by-day process of people getting up, going to work, and solving problems. It is the undramatic, unnewsworthy moments that ultimately build wealth. Actionable step: stop paying so much attention to the dramatic headlines. Instead, focus on the long-term trends. Acknowledge that while there will be bumps in the road, the overall direction of human progress has always been forward. 2. Be optimistic, but have a plan for pessimism. Housel argues that the best financial mindset is a mix of optimism and pessimism. You should be optimistic about the long-term future, but you should be a pessimist in your planning. This means that you should build a financial plan with a large margin of safety, as we discussed in Chapter 13. This will allow you to weather the inevitable downturns without losing your long-term optimism. Actionable step: your plan should assume that things will go wrong. Build a large emergency fund, diversify your investments, and avoid high-interest debt. By preparing for the worst, you can embrace an optimistic view of the future without the fear of being wiped out. 3. The greatest risk is not participating at all. The greatest risk is not that the market will crash. It's that your fear of the crash will keep you from participating in the market in the first place. A person who keeps all their money in a savings account out of fear of a crash will miss out on the incredible power of compounding over time. They will ultimately be worse off than the person who invested and rode out the storms. Actionable step: the best thing you can do for your financial future is to start today. Don't wait for the perfect time to invest. The perfect time is always now, because the longer you wait, the more compounding you lose. This chapter is a powerful reminder that while pessimism might sound smarter, optimism is what ultimately builds wealth. By recognizing our bias toward negativity and building a plan that can withstand the inevitable storms, we can create a financial life that is not only prosperous, but also resilient. Chapter 18. When You'll Believe Anything. This chapter delves into the profound influence of narrative on our financial lives and the economy at large. It argues that while we tend to focus on tangible economic factors like factories, technology, and jobs, the most powerful force is the stories we tell ourselves about money. The chapter uses a powerful metaphor of an alien observing Earth's economy between 2007 and 2009. From a physical perspective, the alien sees little change, the same cities, factories, and technology. In fact, some things, like technology, had even improved. Yet, the numbers told a different story. U.S. households were $16 trillion poorer, and 10 million more Americans were unemployed. The stock market was worth half of what it was. The alien is confused. because the tangible capacity for wealth seemed identical, if not greater. The only thing that had truly changed was the story we told ourselves. In 2007, the narrative was one of housing stability and prudent banking. By 2009, that story had broken, and a new, more pessimistic narrative took hold, triggering a vicious cycle of defaults, layoffs, and reduced spending. This narrative damage was self-inflicted, but had a more devastating impact than tangible economic damage, like the destruction of Germany's manufacturing base in 1945. The chapter identifies two key lessons for managing personal finances in this story-driven world. First, our desire for a certain outcome makes us more likely to believe a story that supports it. This is what the author calls appealing fictions. When facing high stakes and limited control, people are willing to believe just about anything to find a solution, much like people in a desperate situation during the Great Plague of London, who turned to infallible remedies. This explains why people listen to dubious financial advice. The possibility of a life-changing reward makes them willing to suspend disbelief. This desire to believe is so strong that people will invest billions of dollars in funds with poor track records, or in obvious Ponzi schemes like Bernie Madoff's. The chapter emphasizes that a room for error is crucial to protect yourself from these appealing financial fictions. The second lesson is that everyone has an incomplete view of the world, but creates a complete narrative to fill in the gaps. This is a natural human tendency. We don't realize what we don't know, and instead form a coherent story based on our limited experiences. This can lead to overconfidence in our ability to predict the future. We seek out people who promise a predictable, controllable world, even though fields like finance are inherently uncertain. Practical lessons and how to apply them to your financial life. 1. The story you tell yourself is more important than the numbers on your screen. How many of you check your investment app and feel a pit in your stomach when you see a red number? You look at the news, and it's full of headlines about a potential recession, inflation, or some new crisis. This chapter challenges you to ask, is your fear a result of a tangible problem, or is it a story you're telling yourself? Practical application. Don't let the daily financial headlines dictate your long-term plan. Remember the alien's perspective. A down economy isn't a sign that the world is crumbling. It's often just a shift in the collective story we're telling ourselves. The factories, the technology, the people, they're all still there, ready to create wealth. Your job is to stay the course, not get caught up in the emotional whirlwind of the daily news cycle. Ask yourself, what is the most common financial story I hear right now, and how is it influencing my decisions? 2. Beware of appealing fictions. Have you ever been pitched an investment opportunity that sounds too good to be true? Maybe it promises a huge quick return with no risk. This chapter explains why we are so susceptible to these schemes. When the stakes are high, like wanting to retire early or get out of debt, we're willing to believe just about anything that offers a glimmer of hope, even if the odds are low. This is the same psychology that allowed Bernie Madoff to raise billions from sophisticated investors. They wanted to believe the story he was telling. Practical application. The next time a financial opportunity sounds incredible, remember that it might be an appealing fiction. Before you invest, ask yourself, am I believing this because I desperately want it to be true? How is this different from a legitimate long-term wealth-building strategy? 3. Build a wide room for error. The chapter highlights how even experts like the Federal Reserve can be wildly wrong in their forecasts because they subconsciously refuse to consider a truly painful worst-case scenario. We do the same thing in our own lives, overestimating our control and underestimating the role of luck and unforeseen events. The danger isn't just that we'll be slightly off in our predictions, it's that we'll be so wrong that we're not even in the same ballpark as reality. Practical application. This is where you empower yourself. Instead of trying to predict the future, focus on building financial resilience. This means having an emergency fund, diversifying your investments, and maintaining a low debt burden. This room for error is your ultimate protection against the unpredictable. It's the safety net that allows you to weather the storm when the world doesn't unfold the way you wanted it to. What would a wider room for error look like in your life? Would it mean a bigger emergency fund? A less risky investment portfolio? What's one step you can take this week to build that cushion? 4. Your narrative is not the whole story. The chapter concludes with a powerful reminder. We all have an incomplete view of the world, but we create a complete story to make sense of it. Like a 1-year-old who explains her dad's absence for work as simply "he isn't playing with me." We explain the world based on the limited information we have. This can lead to flawed decision-making, because we don't know what we don't know. We think we have control because we focus on what we can do, and neglect all the external factors we can't control. Practical application. Recognize your blind spots. The world of finance is complex, with countless participants making decisions for reasons you can't even comprehend. Instead of trying to be a financial Nostradamus, focus on the things you can control: your savings rate, your spending habits, and your behavior during market fluctuations. The illusion of control is tempting, but the reality of uncertainty requires humility. What financial topic do you think you understand completely, and what might you be missing? Chapter 19. All together now. Have you ever wondered why two people can read the same financial advice, follow it word for word, and end up with completely different results? Or why some people with flashy cars feel broke inside, while others with modest homes sleep like babies every night? This chapter forces us to face a sobering truth. There is no universal financial prescription. Just like medicine, money is deeply personal, and if you blindly copy someone else's formula, you might end up like Clarence Hughes, the man who went to a dentist in 1931 for a toothache and never came home alive. We'll come back to Clarence's story in a moment, because it reveals the single biggest mistake most people make with money. But first, let's zoom out and pull the strings together. Clarence walked into the dentist's office with a simple goal: to fix his toothache. What he didn't realize was that the dentist had his own idea of fixing him. Hours later, Clarence woke up with 16 fewer teeth, no tonsils, and eventually no life. Now here's the punchline. Clarence's wife didn't sue because the surgery went wrong. She sued because he never consented. He never got the chance to decide if the risks were worth it. This is the same danger in finance. Too often people let someone else, a financial expert, a guru, or even society, decide what's best for them. But money isn't one size fits all. Lesson: just because a financial plan works for someone else doesn't mean it's right for you. Even though everyone's financial journey is unique, there are timeless truths, guidelines that work regardless of where you are. Let's walk through them, and I'll show you how to make them practical for your life. Respect luck and risk. Success is never as good as it looks, and failure is never as bad as it feels. Imagine two friends start businesses. One succeeds wildly, the other fails. Is one smarter? Maybe, but often, luck and timing play a bigger role than talent. Application. Instead of judging yourself too harshly when things go wrong, or envying others when they seem ahead, focus on what you can control: your effort, your saving habits, and your ability to adapt. Less ego, more wealth. Wealth is what you don't see. That car, that Rolex, that designer outfit. They're not wealth, they're expenses. Application. Before buying that flashy thing, ask yourself, am I doing this for me or to impress someone else? Real power is quiet. Manage money to sleep at night. Forget about chasing the highest returns. If your portfolio keeps you up at night, it's not worth it. Application. Build a financial plan that matches your risk tolerance. Peace of mind is a form of profit. Stretch your time horizon. The greatest investor isn't the one with the best strategy. It's the one with the longest patience. Time makes small seeds grow into forests. Application. Instead of asking, how can I double my money in 3 years? Ask, what seeds can I plant today that will grow in 20? Be okay with being wrong. Often, in investing, you can be wrong 50% of the time and still be rich, because a handful of wins outweigh many losses. Application. Stop obsessing over every bad investment. Focus on the big picture. Is your portfolio growing overall? Use money to buy time. The highest dividend money can pay is freedom over your schedule. Application. Build savings and assets that allow you to say no to things you don't want, and yes to things that matter. Save without a reason. Life's surprises don't RSVP. That's why a stash of just-in-case money is priceless. Application. Even if you don't have a specific goal, make saving a habit. It's your shield against uncertainty. Define the cost of success and pay it. Every financial goal comes with hidden costs. Stress, doubt, regret, patience. They're not penalties. They're fees for admission. Application. Don't quit just because the journey feels hard. The cost is part of the process. Worship room for error. Always leave margin in your finances. Emergencies are guaranteed. Ruin is optional. Application. Don't budget down to the last cent. Build buffers everywhere. Savings, investments, even time. Avoid extremes. The future you may regret today's extreme decisions. Balance keeps you flexible. Application. Don't over-leverage. Don't underinvest. Stay adaptable. Respect the mess. Finance isn't black and white. Smart people can and will disagree. Application. Stop chasing the perfect strategy. Focus on the strategy that works for you. Imagine two friends, Sarah and James. Sarah invests aggressively, but every dip in the market leaves her sleepless, anxious, and snapping at her kids. James invests conservatively, grows slower, but lives peacefully, knowing his bills are paid and his future is secure. Who's richer? On paper, maybe Sarah, but in reality, James, because true wealth isn't just about numbers. It's about control, peace, and freedom. Here's the truth. Money isn't about beating the market, showing off, or copying someone else's playbook. It's about designing a life you can live with, one that lets you breathe, one that lets you sleep, and one that gives you control over your time. So ask yourself today, am I making decisions that serve my life, or someone else's expectations? Am I saving enough for the storms I can't see? Am I leaving room for error, or am I gambling my future on perfect conditions? Because at the end of the day, the most powerful form of wealth is choice, the choice to live life on your terms. Chapter 20. Confessions. This chapter is deeply personal. It's where the author pulls back the curtain and shares not theories, not formulas, but his own financial life. He calls it Confessions, because it's not about being perfectly rational or textbook correct. Instead, it's about what actually works for him and his family. It starts with an unusual question billionaire investor Sandy Gottesman asked when hiring people. What do you own? And why? Not what's the hottest stock. Not where's the economy heading. Simply show me what you do with your own money. That's powerful, because often there's a gap between what experts recommend and what they personally choose. Doctors treat patients one way, but choose different care for themselves. Portfolio managers advise certain funds but don't even invest in them. Why? Because personal choices are emotional. They're not just about numbers, they're about comfort, security, and peace of mind. The big lesson here, there's no one-size-fits-all financial truth. There's only what works for you and your family. The author's personal financial rules and lessons for us. The goal is independence, not riches. The author shares Charlie Munger's famous line, "I didn't intend to get rich. I just wanted to be independent." His family's financial decisions revolve around independence, not flashy wealth. Independence means working on your own terms, choosing who you work with, having the freedom to walk away when you've had enough. Don't just chase rich. Define your financial endgame. For some, it's luxury. For others, it's freedom. For many, it's peace of mind. Know your why. After college, he and his wife built a decent but modest lifestyle. A simple apartment, a used car, nothing fancy. Even as their income grew, they kept their lifestyle steady. Raises and bonuses didn't inflate their spending. Instead, they went straight into savings. If you can freeze your lifestyle early, every extra dollar becomes fuel for freedom. Most people make the mistake of raising their spending with every raise. They stay trapped in the rat race. What if you could stop your financial goalpost from moving? Imagine the wealth you'd build in 10 years if you lived like you did in your 20s. Owning the house outright on paper, it was a bad financial decision. Mortgage rates were cheap. Mathematically, investing the money in stocks would have made more sense. But owning a home outright gave them psychological independence. No monthly payments mean peace of mind. Not every good decision shows up in a spreadsheet. Sometimes the best move is the one that helps you sleep at night. Would you rather maximize returns or maximize peace of mind? Which one truly makes you rich? Cash as oxygen. They hold around 20% of assets in cash, far more than advisors recommend. Why? Because cash means flexibility. It means they never have to sell stocks in a downturn to cover emergencies. Cash gives them breathing room when life throws curveballs. Always expect the unexpected. The question isn't if a financial curveball will come, but when. Cash buys you resilience. A simple investing strategy. He started by picking individual stocks, but later realized most professionals don't even beat the market. It's hard, stressful, and requires luck. Now his family invests almost entirely in low-cost index funds. His rule: if I can meet my financial goals without taking extra risk, why complicate it? Investing doesn't need to be complicated. Simplicity plus consistency beats complexity plus stress. What if the secret to building wealth isn't being smarter than the market, but simply staying in the game long enough for compounding to work? Practical applications. Step 1. Define your goal of money. Is it independence? Is it security? Is it flexibility? If you don't know your why, you'll forever chase someone else's version of wealth. Step 2. Lock your lifestyle. Freeze it before lifestyle inflation traps you. Each raise should buy you freedom, not fancier bills. Step 3. Build an independence fund. Automate savings. Treat each dollar as buying you time and control, not just stuff. Step 4. Keep cash. A big emergency fund isn't laziness, it's resilience. It's a shield that lets your investments compound. Step 5. Keep investing simple. Dollar cost average into index funds. Forget trying to time markets. Focus on patience and discipline. Money, at its core, isn't about spreadsheets. It's about psychology, family, and freedom. The author admits some of his choices make no sense on paper, but they give him peace, independence, and the freedom to live life on his terms. And that's the ultimate confession. The best financial plan isn't the most rational one. It's the one you'll actually stick with.